right? So you hear doom and gloom about tax and all sorts of stuff happening in Melbourne, but the most optimistic rooms I've tended to find out this year have been in Melbourne. All right, what would I say to that? What would I say to the question, what's the outlook for the economy? And to know where we're going to, we've got to start from, how is the economy going today? And most people, when I ask that question too, put up their hand and sort of say, we're pessimistic because of how things are today. And there's one reason in particular why people are so pessimistic. It's us, right? Economists have this term for our incomes. It's our incomes after we allow for inflation, mortgage payments and tax, real income growth. And if you look at that, essentially over the last 3 years, that's gone backwards in a way we've never seen for at least 60 years. Our incomes have gone backwards in a way we haven't seen at any time for 60 years, right? So if you hear people sort of say, I'm hurting a little bit, there's very good reasons for it. Now it's fair to say that pain is not equally shared. You'll be surprised to say that the wealthy have got more money, so they can actually deal with problems a lot easier. The governments have done a very good job, in fairness to them, of protecting the very lowest income earners. The people who are hurting the most are those in the middle and just below in terms of incomes, because they don't get the same support from governments, but they've still got their mortgages to pay, they've still got their rents to pay, they've still got the food bills to pay, etc., without the same sort of assistance, right? So that's sort of really hurting. We have not been hurt this way in 6 decades. And if you look at the right-hand chart, the way we have been hit is almost amongst the worst in the OECD. Right? So there's lots of talk about how we're going and our interest rates compared to globally and so forth. One of the reasons we've been struggling more than others is that our households have really been smashed in a big way. And it's got to have implications, right? You can't have the worst income performance for 60 years, 6 decades, without some impact. And it absolutely is if you look at the way people spend, right? So there's non-discretionary items, your mortgage, your food, your petrol, and then there's discretionary items. And if you look at that, it's been flat for at least a year. And that number includes the impact of inflation. That number includes the fact that over the last 18 months, we've had this biggest rise ever, that's ever, in terms of our population, because of the big increase in immigration. So we've got more people in terms of the rise, the growth, than we've ever seen before. We've seen inflation, and discretionary spending has been absolutely flat. That has made it very hard for people in that industry. All right, so that's discretionary sort of outcomes. Just so that you're aware, so you know what's and what's, Taylor Swift tickets are non-discretionary items, right? Just so you understand about what's in what category. That is what's happening in Australia overall. What can we say what's happening in Melbourne, right? 2 classic things. Restaurants is discretionary, food is non-discretionary. What did we absolutely see? The price of food went up a lot. And as we went from the end of 22, gradually, spending at Melbourne restaurants has come down. And if we hadn't had all that immigration growth, it would have been a lot worse. Because if you look at the right-hand side, what did we start to see? The big fall in that local spending from the end of 22, and it was only offset by a big rise in people coming from overseas. So discretionary spending in Melbourne has been absolutely smacked, as it has been Australia-wide. As I said, there's different things between different sort of households, all right? And there's 3 sort of categories up there, right? One is sort of, if you look at people who didn't have a mortgage. Now, everyone's hurting from the cost of living. Everyone sort of looking at their coffee, why am I paying $5.50? Everyone's looking at the cost of a restaurant meal. Everyone's looking at the cost of meat. Everyone's sort of saying things have got a lot tougher. But if you look at those that don't have a mortgage, their sentiment is best. Why is their sentiment best? One of the reasons is that right-hand chart. If you look at, ask any banker, what's one thing you're seeing? You're seeing in a bank, there's a mountain of deposits right now. If that's what the right-hand chart shows you. And who's got the mountain of deposits? It's basically those that don't have a mortgage. right? They've got the ability to actually save. The second one, what we started to see from the end of last year, is a bit of a pickup those with mortgages. Why was that, you sort of say to yourself? Because your mortgage payments have gone up. The reason for that is, as we've gone through this year, people sort of said, actually, we've had enough of rate hikes, the next move might be down. You've got that, plus your house price has gone up. Lo and behold, their sentiment has started to improve also. But there's one group in particular that are hurting, and that's the renters, right? If you're a 24-year-old at home, you're buying your Taylor Swift tickets. But if you're out there renting, your income's above the minimum, then you're the one that's really hurting most of all. So there's a real different impact overall, but all households have been hurting big time. And of course, this influence, the fact that discretionary spending really been hit hard, has impacted this industry. And I looked at sort of, to use an analogy, the Google searches for caravans, and there's a couple of things to note. First of all, as you undoubtedly have seen in your business, that's come down pretty sharply over the last 12 to 18 months. The second thing to note though is where those searches are today is still above where it was pre-COVID times. Right? So things are not as bad as, things are nowhere near as good as it was 12 or 18 months ago, but they're still better off than they were pre-COVID. The other thing to note about that chart is the trend. Over time, the trend search for caravans is up, right? Because people are liking getting out, people are like the sort of service side, enjoying their life, and of course there's the general ageing of the population. So very good news for the medium term, but of course there is the short-term issue of the household disposable incomes. So the first bit, we asked the question, how's the economy going? The economy, frankly, is struggling. Growth is flat as a tack, and the principal reason is our incomes have been smashed. That's households. What do we say about businesses? All right, so household sentiment, as we sort of see, is flat bottom. If we go back 12 or 18 months ago, businesses by and large were sort of saying, guess what, things are great. People were out buying, and because they were buying so much, because there was a shortage of so many things, any cost increase I could just pass on. Pass on to who? Pass on to us, the people. We had to pay it, but not for businesses. They could actually pass on those costs. So for a while, businesses could maintain their margins, and because there was a lot more of us, big immigration, more people, same margin, businesses were feeling pretty good about things 18 months ago. And so while consumer sentiment was rock bottom, business sentiment was sky high. But we, the people, we're 55% of spending in the economy. If we, the people, hurt long enough and hard enough, eventually it must impact businesses. And lo and behold, what have we seen over the last 12 or 18 months? That business sentiment has started to come down and down and down. In fact, if you actually ask businesses today, how are things? They'll sort of say, okay. How are your order books? They'll say, well, in actual fact, my growth of my order books is actually pretty weak right now, suggesting that things in this half of the year will clearly be weaker. So what have we got there? We've got basically households really hurting in a way we have not seen in terms of their incomes for at least 6 decades. We've got businesses saying things are okay today, but I reckon the second half of the year will be a bit of a struggle. So if I was sitting right there and asked the question, which I asked everyone here at the start of the presentation, what do I think the economy will be this time next year? I'll be absolutely putting up my hand saying this time next year things will be better. Now, you're probably sort of saying, hang on, champion. You've spent 15 minutes going through sort of saying how things are really bad. How are you just going to sort of say things are going to get better from here? Well, one reason for it is we've just got so much to do in this economy. Right? Here with the big build, there's so much infrastructure work to be happening here. That big mountain there is the largest mining boom Australia has ever seen in its history. Ever seen in its history. That next bump there, the next little mountain, is where we are today. That is the second highest amount of engineering building work we've ever seen, relative to the size of our economy. And that number there does not include all the homes we must build. That does not include all the additional stuff that we must do for green energy transition. That number you see there does not include any of the work that will have to be done on the defence side. So when you add all these things up, whether it be infrastructure, whether it be housing, whether it be defence, whether it be green energy transition, and by the way, we are spending literally tens of billions of dollars in the health sector, in the aged care sector, in the child care sector. When you add all that up, to be frank, it's very, very, very hard to get too pessimistic. But as the old ad used to say, but wait, there's more. As I said to you, the number one issue we have in an economy right now is we the people, how our incomes have been smashed in a way we have not seen for at least 6 decades. But the good news is that's starting to change. But it's already changed. Already is the case that people have got more spare cash. And how do we know that? It's called tax cuts. The other big thing is, as we spoke about at the start, as you told me at the start, inflation rate has come down from the 7s to 8s, and now it's in the 3s to 4s. Most people's wages growth is growing now faster than inflation. So they're covering price growth, and there's a little bit extra, and they've got the tax cuts, and there's starting to be signs, only some signs, that rents growth is starting to slow. So if you add all that up, gradually, households will start to have extra cash in their pocket. And the big question we've got is, what are they going to do with it? And in some cases, they have to spend it, because if you're a low middle income earner, you have been making a choice. Do I buy the pint of clean or do I buy the bread? Because they've been that short of cash. So they have to spend it. The bigger question is, what will other people be doing with their extra money? That's going to be a big question about how things go. So you've got this basic thing. There's so much building to be had, and for households, things are getting better. And those things mean the economy will be in better shape. Which leads me to the third point. So the first one is the economy right now is not great. The second one is the economy will be getting better. And then that leaves the big third question. What does that mean for interest rates? Now, in recent time, there's been, shall we say, speculation that rates may need to go up. And there's a good reason for that, right? The Reserve Bank wants the inflation rate to be 2 to 3%. It's been above that for at least 3 years. It could be 4 years. The more they say, oh, but at some point in time it'll come down, and the more it doesn't, the more people sort of say that's rubbish. It's going to remain too high for too long. And the implication of that, if inflation stays too high for too long, interest rates start to go up. One of the surprising questions I've had over the last couple of years has been, will I see a 17.5% mortgage rate? Now, I'm looking through here. This is an extremely young audience, right? So no one here would have had a mortgage in 1989, so this is just a history lesson for everyone here. But the answer I give to those people of 17.5% mortgage rate, because that's what it was in 1989, is a 17.5% mortgage rate in 1989 didn't start because of something that happened in 1987. It started because of something that happened in 1972. Because in 1972, inflation started to go up, and then they put in interest rates. Inflation started to come down, but by the time the economy picked up, inflation hadn't come down enough. So the next time the economy picked up, inflation went up even more, so interest rates had to go up even more. And that cycle of inflation not coming down enough and inflation keep going up ended up meaning that by 1989, interest rates were 17.5%. So that's the big thing the RBA is worried about. If they keep inflation too high for too long, that structure of interest rates will go up. So it has been high for too long. And people sort of saying, maybe rates will need to go up again. And we get in 2 weeks' time a very important inflation number. That is clearly above what the RBA wants it to be. There is a risk. There is a risk that they might increase interest rates. Do I think that is the right move? Remember what we've spoken about here. The economy right now is flat. We are producing more stuff. Slow demand, high supply. My math says that should mean in time lower prices. So you're going to get sort of lower prices coming through. You can see that from this chart. And the other thing is, if you look what's happening globally, right? The US is talking about cutting interest rates in a couple of months' time. In Europe, they already have. They're talking about doing so in England and in New Zealand. In Canada, they cut rates last month. If you look through that chart, typically if interest rates come down in the rest of the world, sometime not far away, they tend to follow here. That's not all the time, but usually. And the final bit, for those that look at the currency, we've actually got the highest Aussie US rate we've seen for some months. Higher rate slows our economy, higher rate actually reduces the price of us stuff to import. All that says to me is that right now we've got a flat economy, we've got a higher Australian dollar, I think inflation will be coming down. It says to me the next move will be down, but not until next year. And the other important bit, remember that chart I put up about how much work we've got to get done? Can you imagine if we cut interest rates a lot with all this work to get done? What would happen to our economy? So this chart tells me that the amount of interest rate cuts, reductions in this cycle won't be substantial. It might only be as little as a half a percentage point, maybe a little bit more. So story for interest rates, next move probably down. We'll see with the inflation number, but when it comes down, it'll be by less than usual. What if I'm wrong? What if the RBA ends up hiking rates, increasing interest rates sometime in the next couple of months? It'll certainly achieve its inflation target, but at the cost of a substantially weaker economy. Because we're already starting to struggle, right? So they put up interest rates from here, I'd be absolutely certain that those sort of flattish GDP numbers would start to turn a little bit negative. And if you get that, what you end up getting next year is interest rates absolutely will be coming down, and probably by more, because the economy's in a weaker state. Right, so if we stay where we are, interest rates stay flat for long, and then they start to come down a bit. If they end up putting interest rates in the next couple of months, you end up getting it down next year, but probably by more because the economy will be in a worse state. So those inflation numbers are very, very important about seeing what the outcome is. So look, there it is overall, that right now our economy is not in a great state. It is pretty flat. I think things, as the song would say, will get better, or can only get better. This time next year, the economy will be in a better state. How much stronger is the important point. I think the next move will be down, but the inflation numbers over the next month or two will play a critical role about whether I'll be right. So look, I might leave it there and open it up to any sort of questions or comments about how people are seeing how things are going. Yep.
Look, I'll ask the really controversial question about interest rates, whether they're the right tool to slow the economy down. It's really attacking the supply side problem and the demand side tool. And there are other mechanisms to slow the economy.
So for those that couldn't hear the question, it was, should we be using interest rates right now and in terms of slowing the economy? And there's a couple of points. One is your point, is most of the inflation driven by supply problems? And the most classic problem here is housing. Yes, there's very strong demand because of immigration coming in. Nothing interest rates can do about that. And we've just structurally underbuilt houses for at least 5 years. Right? So there's nothing that interest rates in the short term can actually change about that. The second way that question is put to me is that why is it that it's 38% of people have a mortgage? Why are they the ones that have to carry the load for slowing the economy? Right? What about the other 62? And the short answer to that is, look, it is a bit of an issue that if you look through governments, they are providing a fair bit of support to the economy. Now, if you look where that support is, as we talked about in terms of who's been hurting and so forth, the goodish bit of news is that most of it, not all of it, but most of it has been given to the low income earners. And as I said, this is the worst cost of living crisis, if we use that term, people have seen for 6 decades. Now, personally, I think it's actually justifiable for governments to support the lowest income earners in that period. But there is a general question. Should the governments, as an example, be focusing so much right now on big builds, creating some inflationary pressure? Perhaps they should be stopping some of that to allow inflation to be lower, therefore interest rates to be lower. So I think that's where part of the problem is, that the federal government's spending a lot in terms of the health and education space. It's driving prices up in that space. And all state governments, not only Victoria, are driving a lot in the infrastructure space, which is actually one of the things, an important driver about why we're not getting enough building in the housing stuff. So I think that is a bit of an issue. The second thing though is that if you look at demand for workers right now, right, so anyone that owns a business will tell you 12 or 18 months ago, by far the biggest issue that they had was trying to find workers. If you actually ask business people these days, how is it you're finding workers? They'll sort of say, actually it's a lot easier than it was 12 or 18 months ago. That's the case of virtually every industry, but it's still not easy. Particularly find good people, right? That's still, it's still not easy. And that means there's still reasonable demand in the economy to get stuff done. So in that respect, all the issues are not only supply, there is some demand question. But if we go back to that very first chart, and I'll chuck it up there. Here we go through. There. If you look at the right-hand side, people sort of say our interest rates should be going up because in the rest of the world, in the US it's 5.5, in New Zealand it's 5.5, in UK it's 5.25, in Canada it was 5. All these people had higher interest rates than us. Ours is only in the 4s, low 4s. Why isn't it higher? And that right-hand chart is the answer. We, the people, our incomes have been smashed in a way that very few other economies have been. Our incomes have been smashed in a way, as I said, we haven't seen any way in 6 decades. So I think that's the explanation about why our rates don't have to go up a lot, but that's also the explanation about why they do have to go up somewhat, because demand was very strong. Because after all, governments pumped a lot of money in the economy and interest rates were zero. Right? So you have to unwind some of that sort of stuff. I'll promise the next answer won't be so long.
Did they take too long to use that lever?
So
did they start the rises too late?
So the question was, did they take too long to increase rates? And the short answer is yes. If you look where everyone else increased rates, we were probably the last of the major economies. Now there was good reason for that, because we were almost the last to open up our borders. So in that respect, in terms of really getting some of the economy pumped up and so forth, we were sort of almost had to be the last to go. But we're probably 3 to 6 months too late. And if you look through, if they had their time again, I think they would say that was the case. Probably the other thing, if we had our time again, the government, federal government, rightly pumped up the economy big time in 2020. They then did it again in 2021, by at least as much, which goes back to the previous question. And did they need to go in at least as much the second time around? And in hindsight, the answer was probably no, because once we opened up, there was oodles of money to be spent, but not oodles of caravans to buy, right? And so I think that was the other part of the issue. It was not, in terms of the question there, is not only a monetary policy one too late, but it's also a fiscal one, we spent too much. So I think it was a double bunger.
So is that what's led us into this sort of period of, like, you could possibly call it stagflation?
Yeah, so the question was, is it pure stagflation? Stagflation is high inflation, high unemployment rate. Our unemployment rate is still really low, right? What we've got is a different sort of game plan, right? Because we've got the combination of tax payments and interest rates really eating into our income and inflation. So that's why we're hurting. It's not so much we can't get jobs, we know we can't get the workers. In fact, we have a record number of people working more than one job. 1 in 9 workers are doing more than one job because they have to be able to meet the mortgage payments and the food and so forth. Right? So that's the reason why we feel it so bad, that sentiment thing, which is as bad as a recession. The last time it was as bad as that was the 1990 recession, which is the worst recession in the 1930s. It's not so much about stagflation from jobs, but it's just that we can't do anything where our incomes, and we just hurt so much from that. So that's sort of the unusual thing this time. We've all got jobs, which is great, fantastic, but our incomes have been hurt so bad. What the Reserve Bank and the government is trying to do is that, it's great, isn't it? So many people who may not have typically got a job have got a job. And when you're in a job for a while, all of a sudden you learn skills. You know, I've got to turn up for work, I've got to look well, I've got to present well, I have to do the right thing, all that type of stuff. Those skills, it's fantastic that so many people who normally wouldn't get them are getting them. And one of the things that the Reserve Bank and government's trying to do is, now we've got so many people in jobs, let's try and keep them in a job, which is another reason why the rates haven't gone up as much as they have overseas. Yep.
About
So I couldn't hear that last bit.
What do you see with business financing? As you were the bank, you guys see less business loans or more? Where is that going?
So the answer to that is that business loans are still quite reasonable, but not as good as they were. There are some areas in particular where things are slowing, and it's residential construction is an obvious one because we're not building a whole lot of homes. More generally, anything that sort of consumer discretionary space is a real issue. But there are other parts of the economy that are doing well. And it's the reason why business credit's still reasonable. And if I go through what are those, it's anything associated with government spending, the infrastructure, anything associated with machines and so forth with that. I won't say as right. Anything to do with the green transition. There's been a notable increase in some areas of defence. So there's starting to be some spending there. So anything to do with government spending, because they've got the money, that sort of lending is still holding up okay. Anything to do with consumer spending by and large, particularly the stuff that they don't have to spend money on, that's coming off. And I suppose the other bit I'd say, not so much on the business space, but on the household space, what we're starting to see is, there is some pickup in housing lending, just because, to be frank, it's the fear of missing out. And the good news is in Victoria, we're seeing more home loans go to first home buyers because prices haven't gone up a lot here. But if you go to Queensland, South Australia, WA, to some extent New South Wales, just the fear of missing out means people are getting out home loans because they feel like they have to get it, otherwise prices are 5 or 10% more. Any other questions?
Just one quick bit.
Yep.
So the commercial borrowing rates have gone about 30% in 18 months.
Mm-hmm.
So I'm assuming they'll take a much longer period based on how inflation is going to bring back that down.
You should know better than I. You're the one handing them out. Look, I would think that there's a couple of things. First of all, what is the cost of money doing in markets and the Reserve Bank and so forth? And we spoke about that. That might take a while to come back down until next year because of the economy and inflation and so forth. The second one is basically competition. Right? And, one of the things we are seeing, which is good news for consumers, is that a lot of the banks sort of saying when they're looking around, where's a good space, where is their lending happening, where do I want to be involved in, more of the banks are getting involved in the business lending side, which means that sort of, there is more competition there, which is obviously a good thing for the consumer. Any other comments? Yep.
In 1982,
Well, here we
I
go.
was 12 years old.
Yep.
The average to buy a house was 3 years.
Yep.
Wage to 1. Now it's 14 years to 1. Where are we in 10 years? And the second question, I'll give you two questions so you
Yep.
can think about the first one. The second one is, when Howard handed over the reins to the Labor government back in whenever, we were in the black. Now we're heading towards $1 trillion in the red.
Yeah.
When the GFC started in the world in 07, America were at about 15 trillion in the debt, now
Yep.
35 trillion. Where are we in 10 years?
Right.
We're just living on borrowed money.
I like it. You did what I did, except I did today versus next year. You're doing 20 years, 40 years of time versus 20 years in the future. So first one, just remind me the first one, it was about Howard.
The ratio.
The income. Yeah. So look. So there's a couple of things there. First of all, we in Australia have had the strongest population growth of anyone in the OECD. No one's had more people come here than us. Second of all, if you look where the people come here, they only come to really 4 places. They go to Brisbane, they go to Sydney, they go to Melbourne and Perth. So we have more people than anyone else come, and they only come to 4 cities. Third, if you look at where people live, we have, besides New Zealand, more people live in a house versus a unit or terrace than anywhere else in the OECD. And if you look at the size of our houses, since that 40 years, they've only got bigger. So we've got more people living in the same space, all living in houses that have got bigger. Right? So that's been a really big driver. The next bit is that, you talked about John Howard, essentially since the end of the Second World War up to John Howard 2007, we had 100,000 people that come in a year. And then what John Howard did was we needed a whole lot of people for the mining boom. He changed the rules that if you came here and you're here for a while, you could actually find it easy at work, particularly if you studied. So half the people that come here are students and half those stay, which has been good for us. We've had a whole lot of young people paying tax, which we need as an ageing population. It's increased our education sector. The problem has been, particularly over the last 15 years, the problem has been is that we've had a lot more people, but our ability to increase the number of homes to build has not gone up anywhere near as much. And there's been two main reasons for that. One is, I'm in Sydney, but you can go to Hobart, you can go to Noosa, you can go to Byron Bay. They're all bad. There's a couple of areas in Melbourne. The councils just don't make it very easy to build places. The second one is, at the same time as we want to build all these homes, we talk about the infrastructure, et cetera, we just have not got enough people that work in construction. We just have not got enough. So we have not had the ability to build as many homes as we need for all the extra people. Now, for quite a while, we got away with it because we had excess homes. But now we've used it all up. That's why the vacancy rates are so low. Right, so it's essentially over the last 15 years, it's been driven by a demand and supply run. For the last 15 years, what it was driven by was the fact that all of a sudden interest rates were 17.5, then they got down to, let's call it 5.5. With that extra 12% reduction, people could actually borrow a lot more. So when they went out, how much can I borrow? Oh, I can borrow $800,000. I'll do that. I want this house. All of a sudden I bid it up. So that reduction in interest rates was the first big driver that drove house prices up. And in the last 15 years, the biggest driver has been the demand supply problem. Right? And that's sort of the problem that we're trying to address today. The second one on the budgets and so forth like that, John Howard banked a fair bit of the budget surpluses. We had a massive increase in our commodity prices. We had unemployment rate at 4%. We had wages growth at 4% plus. So they banked a fair bit of it, but John Howard also spent a lot. So if you sort of took away the state of the economy, which was white hot then, if you took away that state, what you'll find out that John Howard really was running about a balanced budget. Now these guys are running, again, they've got commodity prices really high, they've got unemployment rate at 4%, they've got wages growth over 4%, they're banking some of it, budget surplus, but if you take away the state of the economy, they're really running a budget deficit of about 1%. Why the difference between John Howard and the current guys? Well, we've got the worst cost of living crisis in 6 decades. We have a Labor government whose only majority is 2 seats, and it's their first term. So if a Labor government with a small majority in their first term can't spend more money for cost of living crisis, then they never will, right? So I'm not that worried about our current stance of the budget. I am a little bit worried though, that given we've got the best terms of trade ever and a very low unemployment rate, our total debt is higher than probably what we need. So we probably should be doing better on the budget, particularly as the cost of living goes down. I'm less worried about us. I'm a little bit more worried about Victoria, to be honest, and probably where Queensland's going. I'm very worried about US. Because the US, as you mentioned, their budget deficits are huge right now. Like, we've got budget surpluses, their unemployment rate's the same as ours, and they're running the same size budget deficit as we ran during COVID. So you remember when Morrison and Frydenberg were spending all that money? They're doing it exactly right now when their unemployment rate is as low as they've seen in decades. It makes no sense. So they're spending all this sort of money, and there is, Trump and Biden, if you look through all that, they're saying nothing about how they're going to improve the budget, nothing. So how are the Americans getting away with it? They're Americans, so they get away with it. But at some point in time, you cannot keep having budget deficits this size with the amount of debt that they have. So if I was going to sort of say, what's something on a 10 to 20 year view that you're really worried? Is it climate change? Well, it's a bit of an issue. It'll probably get a bigger issue. Is it sort of geopolitics, US-China? Yep, that's a real worry. But the number one thing is the debt, and it's debt in the US government, and it's debt in China. The two biggest economies both have serious debt issues. And how that plays out is going to play a big role how our economy goes over the next 10 to 20 years.
Do we really know how bad it is in China?
Do we really know? The answer is that they're... So I'll tell you a story that years ago, the Chinese would have an economic number, GDP number, and invariably the number was very close to their forecast. And so I worked in Canberra then, so we said to the Chinese, look, the Australian government didn't have a very good record of forecasting, hasn't improved much. And so we said to them, look, what do you guys do to get your forecast right? And the answer was, well, we said we wanted this number and we get that number. But, look, we don't absolutely know, but, they had a GDP number yesterday or the day before. The number looked quite reasonable, just went with the facts. We were worried about where the Chinese economy is going. The GDP number came out less than we expected. Where it was strong is the thing that everyone spoke about, electric vehicles, batteries, all that sort of stuff, solar panels. That's where the Chinese economies you think would be strong from everything you read, and it was strong. They're exporting a lot of it, so that's the case. You're worried about the consumer has been weak, the numbers showed it was weak. So if you actually look at the numbers from the GDP, it makes absolutely sense in terms of what you're actually saying. So I think those numbers look reasonable. There's some debate about how much debt there is, but it doesn't matter how you calculate it, it's a reasonable amount, and they know they have to do something about it. And the big question they've got is, what do they do about it? How do they keep the economy going with this much debt? If you look, as you probably know, they've had a massive problem about borrowing too much for housing. They're not the only economy that's ever happened to. It's happened to quite lots of economies. Have a guess about how many economies have successfully dealt with that without having a recession. And the number is 0. Right, so trying to not have a recession with dealing with a big problem in the housing market, too much debt, is a very difficult thing which no one has successfully come up with a solution, and they're trying their best to actually do it. So we don't, they're not as transparent as us, but I think most of their numbers are quite reasonable, but they're dealing with a massive, massive economic problem. I'll tell you what, that was a pessimistic way to end anything, wasn't it? I wanted to say things are getting better, and then we've got sort of massive, massive problems.
No one talks about it.
What's that?
No one talks about it.
About China?
No, about the Americans. How can you not, from 15 trillion to 35 trillion in 14 years,
Yeah.
we've gone from black to 1 trillion.
Yeah.
We all live on debt now.
Yeah, there's no one talk about it. So it was a bit of a thing in financial markets about 6 or 9 months ago. But why isn't it talked about enough, which is really a question.
Believe their own bullshit.
Well, and the reason is, but the bottom line is that nothing's really happened yet. So until something happens, then people are not going to be that worried about it. Yeah.
And they don't have a meeting and say, we'll just raise the debt ceiling.
Yeah.
They do it every 12 months now.
Yeah, and as I
They
said,
have a meeting and we'll just print more.
yeah, as I said,
By law, they're allowed to print more.
yeah. So until something happens, something happens. Any other questions? Yep.
You mentioned earlier that there may be a possibility that the RBA may raise the interest.
Yep.
Just given that the tax cut had just been introduced,
Yep.
would the increase in the rate negate the benefit introduced by the government?
Yes, is the short answer. Which is one of the discussions that came out with all the budgets, federal and state, we've had over recent months. The concern that basically our government's putting too much money in and could cause the Reserve Bank to do something at the time when inflation is too high. So that absolutely would be one of the issues. So there's one issue in terms of the overall economy, and the second thing, of course, is that what the impacts would be. Because everyone benefits from the tax cuts. Some people benefit from higher rates if you're a saver, put money in deposits. Obviously, if you're a borrower, have a big mortgage, then, as you say, for those people, the benefits of a tax cut would be offset by the higher rates. So that would be an issue. Hopefully, we're not going to get the higher rates, which I don't think we will, but we'll end up seeing. I cannot overstate in terms of how the economy is going. The biggest issue is people want more money. What do they do with it? That's the biggest question over the next 6 to 12 months. All right, unless there's any other further questions, or Daniel wants to do the second part of his presentation as he did with the fire guys, I might leave it there. So thanks very much for coming along. Thank you.